Hello. So we already discussed the background of estate tax. So in part one, this is part two. We forgot to discuss earlier the deductions, the allowable deductions from the gross estate. So today we'll discuss that. In my slide, you can see here summary of deductions for estate tax purposes. We compared side by side the deduction for if the decedent is a resident citizen and if a decedent is a non-resident citizen or a resident alien. On the other side, on the right side, you'll see the deductions allowable if the decedent is a non-resident alien. So if you compare that side by side, you'll see that the standard deduction of 5 million is available for resident citizens, non-resident citizens, and resident aliens. On the other hand, for non-resident aliens, the standard deduction is only 500,000 pesos. For claims against the estate, there are three types. It's claims general one, claims against the estate, or very specific claims against insolvent persons, or unpaid mortgages, taxes, and casualty losses. For these three, for resident citizens, non-resident citizens, or resident aliens, the claims are deductible as long as it meets the requirements. And we'll discuss the requirements one by one in this video. When the decedent is a non-resident alien, the claims against the estate will be subject to this pro rata computation. Okay, so you would get the Philippine gross estate versus the total worldwide gross estate times the whatever claims against the estate is indicated. That would get you to the allowable deduction from the estate that is located within the Philippines, because they are only subject to estate tax for those properties that are located in the Philippines. For property previously taxed, it's an available deduction for both types, okay? Also for transfers for public use or properties transferred for public use. But for family home, that's not available for non-resident aliens, and also amounts received by the heirs under RA 4817. And then for the net share of the surviving spouse in the conjugal property will be um, available for both types of decedents. Okay? So let's go to the next slide to discuss the types of the deductions. For the claims against the estate, we have this concept called the date of death valuation rule, which um, which tells us that a claim against the estate must be certain and enforceable on the date of the decedent's death. Okay, so the amount that is due on the date of the decedent's death. So the fact that the claimant subsequently settled for lesser amount will not preclude the estate from deducting the entire amount of the claim of the estate. Okay, it will not preclude the deduction of that entire amount. So whatever is known at the date at the time of death. So post-death developments, we state here, post-death developments are not material in determining the amount of the deduction. What are the requisites of deductibility? One, this is very specific to claims against the estate, the general type of claim, right? So whatever claim. So you might ask, what is a claim, ma'am? So it means it's a debt or a demand that is enforceable against the estate. So the requisites of the deductibility are four, as listed here. Okay. The first one is that there must be a personal obligation of the deceased existing at the time of his death. It must be already existing at the time of his death. It can be proven that it exists. It is contracted in good faith and for adequate and full consideration in money and money's worth. The debt must be valid in law and enforceable in court. So I remember a question before which asked whether whether a gambling debt is a deductible claim against the estate. The answer would be yes, would depend, right? Because if it's a gambling debt that's illegal, then it will not be enforceable in our courts. But of course, already have PAGCOR, so you need to be very careful with answering those type of questions because PAGCOR is a valid existing gambling place right now in our country. So number four is the fourth requisite is that it must not be condoned by the creditor or that the debt is not yet prescribed. Of course, this number four is actually a clarification of number one, right? Because if it is not condoned, meaning it's still existing and valid at the time of death, right? So not prescribed, it still boils down to the requisite number one, that it is existing at the time of death. So what about claims against the persons? Okay, claims against insolvent persons and mortgages. For claims against insolvent persons, you have to be very careful because it's not everyone that claims they cannot pay the debt can be can be considered as a claim against insolvent person. You may only deduct the amount from the total gross estate if the debtor is really incapacitated and it is already proven that the debtor is incapacitated. It is not merely alleged. Okay? The insolvency must be proven and not merely alleged. For mortgages, the primary requisite is that if there is a mortgage, you need to first include the property. If it is a land, then you need first to include that land as part of the gross estate of the deceased, and then include as an allowable deduction the amount of the mortgage. So it must be included first in the gross estate so that you can include that in the allowable deduction. For the mortgage must also be contracted bona fide and for an adequate and full consideration in money or money's worth. For unpaid mortgages, okay, it must be noted, it must be verified that the money really went to the decedent. The one who benefited from that mortgage is the decedent. Because if it's not, if there's proof that the decedent did not get any money or it's a mere accommodation loan, then you know accommodation loan, right? The decedent let someone use his name to obtain a loan. If that's a mere accommodation loan and the decedent did not receive the proceeds of the loan, then that mortgage will not be a deductible expense from the gross estate. Actually, the the land, if it's the land that was mortgaged, the land is part of the gross estate, but the receivable or the mortgage would be not a deductible expense, and you will record an accounts receivable, meaning you will record the receivable, the asset, the receivable of the estate from that person who actually benefited from the loan. Okay. So we're keeping these videos short, less than 30 minutes because it's kind of difficult to upload it if it takes more than 30 minutes, right? So bear with me, class, to have these videos in different parts. So for taxes and casualty losses, these are the general rule. Okay? If it has occurred as of the death of the decedent, then it has accrued and not yet paid, meaning it is already incurred. Okay? It's already due and incurred, but it remained unpaid as of the date of the decedent's death, then it will be deductible. But take note, there are taxes that are not deductible. And what are these? It's listed here. It includes income tax that are paid after the death of the decedent, property taxes which have not accrued before his death. So property taxes, what are the different property taxes? We'll also discuss that in tax 2. Estate tax due from the transmission of his estate. So the estate tax that you compute, right? So how do you compute the estate tax? Gross estate less allowable deductions. In that allowable deductions, you cannot also include there the estate tax that is computed using that same formula. Okay? For the casualty losses, the general rule class is that it is deductible. But you need to be very careful because these casualty losses talks about the losses that are incurred when or during the settlement of the estate. And it must arise from firestorms, any of these circumstances. The question would be, why would casualty losses um, only include those that are incurred during the settlement of the estate? Why not before? Because if it's before, it might already be under a different category. It could be under claims against the estate, right? Or if the property is already gone, then the property will not be included in the gross estate anymore. So in this scenario, casualty losses, the property is still in the gross estate because it is present at the time of death of the decedent. But you're allowed this deduction because the property is actually lost already because of fire, storm, shipwrecks, or other casualties. And very important is that it is not compensated for by insurance or otherwise. And it is not claimed as deduction for income tax purposes, for income tax return. Because to recall, we know that for income tax purposes, there is this allowable deduction called losses. For losses, as long as you comply with the requisites of losses, you can claim casualty losses as a deductible expense. And then the last and fourth requisite is that the losses were incurred not later than the last day for the payment of the estate tax. Okay, so it should be within the time that you pay the estate tax. You take note, when is the deadline of payment of the estate tax? That would be within 2 years, right? But for the payment, you can still extend, right? So the loss must be incurred before that date so that you can still claim it as a deductible item for your estate tax purposes. Okay, this topic, we're on to the next topic, property previously taxed, which is a very challenging one because I understand for accountants, property previously taxed is already a given, right? You already know about this. For those that are that have encountered it the first time, right? You need to really read on this because this is a unique provision in our estate tax. So it allows the decedent, it allows the estate to deduct this type of deduction. So you need, what are the requisites of this property previously taxed? This is commonly called also as vanishing deductions. You will know why it's vanishing. So the first requisite is that the decedent must have previously acquired the property either by donation or succession. So the the property is just recently acquired, okay? by the decedent. Either it was donated to him or it was through succession. If, for example, A, the father, died and a land was inherited by B, his son, and B, his son, has also died, and the son of B, C, which is C, inherited that property from B. So the time when A and when B died would be very important to determine the amount that you can claim as a vanishing deduction or PPT, property previously taxed. So the time interval between the death of A and the death of B must not be more than 5 years, okay, to be able to claim this deduction. And the third requisite is that the property must be situated in the Philippines and that there was no the previous estate tax. So in our previous example, A, upon the death of A, the property was transmitted to B. So the transfer from A to B must be previously subjected to estate tax. Okay? It must be previously paid. So that when you compute for the estate of B, the son of A, then you can claim this deduction. The fifth requisite is that there was no previous vanishing deduction on the property. So what are the rates of the vanishing deduction? If in our previous example, if A and B, if the death of A and the death of B will be within 1 year or less, the deduction will become 100%. So effectively, if A died within 1 year, if B died within 1 year from A's death, the entire property will not be taxed anymore under the estate tax, right? Because the deduction is 100%. So the computation is that as I initially informed you before, you include it first in the gross estate, and then you include it as an allowable deduction for vanishing deduction of 100%. Effectively, that entire property is not subjected to estate tax. So for if the time interval, okay, is more than 1 year but not more than 2 years, that would be 80%. If more than 2 years but not more than 3 years, that's 60. But more than 3 years but not more than 4 years, that's 40. More than 4 years but not more than 5 years, that would be 20%. Now, I think that's all for estate tax. No, sorry, I forgot. We still have this one. We still have transfers for public use. For transfers for public use, the requisites for the transfers for public use would include that the disposition is in the last will and testament of the decedent. So it is included in the will. The second requisite is that it should take effect after death, of course, because it's in the will, right? And the third one is for the use of the government. And last one, it must be for public purposes. So there were questions before whether using it as a public park can be considered as a use for public purpose. The answer would be yes, it is still for public purpose. For the next, as long as these four requisites are present, then that property may be an allowable deduction, the value of that property. Family home is an allowable deduction, but it must not exceed 10 million. It must be considered that for family home to be a deductible allowance, it must be constituted jointly by the husband and wife as the dwelling house where their family will reside. So for some estates, there are a lot of houses. Okay? The identification of which house is the family home okay, will be left for the family members. It must be um, the dwelling where the family reside and on the land on which it is situated. So family home would include the dwelling and the land. What are the requisites for the deductibility? So it is identified actually by the beneficiaries themselves, okay, for family home, which is the family home. The requisites for deductibility is that it must be the actual residence, as mentioned already, the first one, actual residence of the decedent and his family, and it will be certified by the barangay captain of the locality where the family home is situated. The total value of the family home must be included first in the gross estate, included in the gross estate, and then the allowable deduction would be up to 10 million only. Of course, the family home could be as high as a billion pesos, right? But the allowable deduction is only 10 million. So it must be part of the properties of either the absolute community or the conjugal partnership or the exclusive property of either spouse, depending upon the classification of the property. And the property relations prevailing, of course, at the time of marriage of the husband and wife would depend on that. An unmarried head of a family on his or her own property, it must be part of that property of the unmarried head of a family. It includes the actual house that is being occupied as a family residence. And then the family home is generally characterized as permanent, okay? The permanent house of the family. It does not include temporary houses, okay? But the family home can still be considered as such even if the family um, takes vacations away from it, right? What, even if they're absent for a couple of years as a vacation, as long as they know that they have this permanent place where they consider as family home, then that would be considered as the family home for estate tax purposes. For this amount, yeah, we already discussed the standard deduction, right? So um, whatever gross estate it is, the standard deduction is 5 million. So for small estates, the standard deduction alone would make that estate as not taxable, right? But we still need to file this estate tax because there is no more threshold under the current train law. For the amounts received by heirs under 4917, this is 4917, sorry. RA 4917 or Republic Act 4917 is an act providing that the retirement benefits of employees of private firms shall not be subject to attachment, levy, or execution, or any tax whatsoever. So whatever the heirs receive as a consequence of the employment of the decedent, it is an allowable deduction for gross estate purposes. So because you first include that in the gross estate, less, and then deduct it as an allowable deduction. So what are the requisites for this um, amount to be deductible? The first one, it must be received by the heirs from the decedent's employer. Okay. There could be an employment benefit, employment retirement plan, employee retirement plan. So that amount may be received from that retirement plan or um, retirement severance, or what do you call this as um, retirement plan or severance or any other causes of termination of employment, okay, not within the not within the will, not not within the will of the employee. Since we're talking about estate tax, so we're talking about the death of the employee, right? So the amount would be, the third requisite would be, the second requisite is that it is received as a consequence of the death of the decedent employee, and that the amount is included, of course, in the gross estate of the decedent. So there are three. Let's enumerate again. It is received by the heirs from the decedent's employer. It is received as a consequence of the death of the decedent employee. And the third one is that it is initially included as part of the gross estate of the employee. Okay, did you get that? Okay. So for the share of the surviving spouse in the conjugal property, it is, because it's conjugal class, it is computed at 50% because it is assumed that both spouses worked for that property at the time of their marriage. So it is computed as 50% of the entire conjugal property of the spouses. So I think that's it for estate taxes. We'll discuss the our next topic, which is donor's tax.